Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and on tonight's show we're scanning for new stocks on the radar screen of our Market 24/7 watchers. Shaw's Adam Dawes wraps up the market today and reveals what new stock has taken his fancy. Berman Invest Julia Lee looks at the latest stock she's added to her fund. Tribeca's Jun Bei Liu tells us what stocks have impressed her following reporting season. And in the scariest months of all for stocks, September and October, the Switzer Report's Paul Rickard tells us what stocks could be interesting to buy if there is a significant sell-off. So without any further ado, let's catch up with Adam Dawes from Shaw & Partners. Well, to start the program off, I've got Adam Dawes from Shaw & Partners to give us a wrap on the market today and to reveal the stock that he likes nowadays since reporting season, the one that's come onto his radar screen. Hi Adam, how are you going?
I'm well, thanks Peter. Yourself?
Excellent, mate. What happened today on the market?
Well, what an interesting day. We started out lower, it went higher, and then it pretty much finished evens or flat. So I thought it was an interesting day as far as being a market watcher. A lot of the bigger stocks started to peter out a little bit. Resources did quite well. Banks still under a bit of pressure. So I think it's still a mixed market, and I don't know if this market really knows where it wants to go. That sort of 6,000 level is going to be hard, and I think we're going to continue to do some work around that level until the election.
Yeah, it seems to me that America seems more committed to rotate out of their tech stocks at times, and they'll start buying their banks. Yeah. Today we did buy banks, but we don't seem to have the same commitment that the Americans have to rotation. What's your view?
I think it's a hard one, isn't it? Because you've got... And I think there's a big rotation that's going to continue to happen. And that rotation is definitely out of tech stocks. And potentially, you can move into travel, you can move into the banks that are undervalued, and there's plenty of other stocks that have been somewhat hit pretty hard and haven't recovered yet. I think the banks as a whole are going to struggle and continue to struggle because we now know that the holiday, the mortgage holiday is now finishing this month. So we're going to start to, officially it's finished, but the numbers have certainly been propped up a little bit. So I'm a little bit cautious of our banks, to be honest. I'm a little bit cautious on where our banks are going to go for the longer term. I haven't been a buyer of the banks over the last 6 weeks, probably even 2 months now. We haven't been buyers of it. And it's probably been the right thing to wait and watch, see how we go.
And it's going to be very interesting, isn't it? Because the whole Victorian thing can either be a disaster or could be better than expected. And I guess, if the Premier, Dan Andrews, had been a little bit more opening with his, reopening plans, the market would have been a bit more positive. But until we see how Victoria rebounds, we don't really know how bad the life will be for banks.
Yeah, and it's all about how they're getting those home loans that have been on holidays for the last 6 months now to get them paying back again. So I'm going to be really interested to see those amounts that have been deferred for 6 months but then going back into a deferral or non-paying kind of home loan. And that number is going to be quite important for us going forward.
Yeah. Now, Adam, there was a new buy now, pay later business all the way from New Zealand listing today. How'd they go?
Yeah.
How did they go?
Absolutely, exceptionally. It did very, very well, debut. It does say that it means that this sector is very, very hot and will continue to be hot. So I'm a fan of the buy now, pay later, as most people are. So potentially the market might be getting a little bit saturated here. I think it's our 7th entrant into the buy now, pay later sector now, and there's more to come. So we've got one coming up as well. So I'd be a little bit cautious, and I want to see a business model before I'd start investing in that one.
That one was called lay-by, and you say it had a pretty nice rise today.
Yeah, definitely. I don't know the actual figure on the close, but yeah, absolutely, it killed it. So
okay, yeah. I guess the bottom line is the more that come into the markets, the benefit will actually be rendered to the merchant, because ultimately they want their little tag out the front of the window when people go shopping, and that's where the competition could be, which could squeeze their profit. So the bigger ones who are diversifying into more markets like Afterpay, and I guess Zip is doing that as well. Yeah. They're going to be a little bit more protected in that sense.
Yeah, they are, and they've got first mover advantage as well. And I think that's the key for a lot of these things, is that first mover. And you're right, you see Zip and Afterpay on the window of every retail outlet. So they're the ones that have done so, or have done quite well going forward. I think at the end of the day, it is, and even PayPal's now come out and said that they're going to do 4 even payments, so mimicking exactly what Afterpay does. But it will be those other retailers, and it's getting on to the Amazons of the world. It's starting to moving online. There's still a lot of space, and it's just not in retail. You can do it for hospital bills, you can do it for dentist bills.
Yeah.
I mean, you could do it for anything. So the market is quite large, and retail is the first bit, but there's so many more things that they could do.
And the irony is, it's going to encourage more spending at a time when the whole world needs more spending.
Yes, we do. You're right. But even Matt Common came out today and said that he thinks buy now, pay later looks like credit. So there's a little bit of a dig at the market share that they're taking.
Yeah, that's right, for sure. All right, what's the stock that's come onto your radar screen lately?
Yeah, so I've been looking at, and we touched on it before, it's sort of that sector rotation. We're certainly seeing, and it's now is the time to start looking at potentially, and dare I say it, we have spoken about this before, but dare I say it, some of the travel stocks. Because the rotation now that you're going to start to see from the high-end buy now, pay later, e-commerce, fintech, and there is this slow rotation out into potentially some of the travel stocks, because the travel will open up. We've got time, so you don't have to do it tomorrow, but by the time travel's already up and running, those stocks have already moved, and they will have moved quicker. So I'm thinking mid-2021 we'll start to see that pick up. But I'm starting to get some clients set now and getting some good prices for some of these Webjets, Sydney airports, and Qantas. We're getting some of those good, potentially good stocks to start putting into the portfolio for that rotation, that sector rotation coming in a couple of months, if not later.
Well, one last thing before I finish. I've noticed in recent weeks corporate travel has already taken off. But how's it doing it when there's no real business to be selling?
Well, even with Zoom, we're not traveling. No one's traveling. And in fact, I would have thought that one was probably one that you wouldn't buy. The fact that all of the executives aren't going to be going to Melbourne. They aren't going to be going overseas. They don't need to travel. But you're right. It's amazing. It's probably one of those first mover advantages as well. It is a strong business, has a good, strong balance sheet. So potentially they're the ones that are going to move first, and then the smaller ones or the weaker ones might move a little bit later.
Adam Dawes, Sharon Partners, thanks for joining us.
You're welcome, Peter. Have a great day.
Same to you.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, joining me each week as she does, Julia Lee from Berman Invest. Hi, Julia.
Hi, Pete. How are you doing?
Very good. Let's look at the stocks that you've been adding to your fund recently, and obviously after reporting season is a good time to evaluate what looks good and what doesn't look good. So what new stocks have you added?
Sure. Well, some new stocks we've added and some old stocks we've added positions to. And I guess one of the ones where we've been adding positions is Mineral Resources. It has 3 different divisions: iron ore, mining services, and lithium. Look, lithium isn't doing so well at the moment, but it is a growth lever for the future. But iron ore has been doing extremely well, both in terms of pricing as well as in terms of production increases. And look, today we got export numbers from China for the month of August, and in particular iron ore saw its third highest record month. And the other two record months were June and July. So in the last 3 months, we've actually seen iron ore exports to China up by a huge 20% and up 11% in the month to date. So that continues to do well, and that bodes well for mineral resources, especially in terms of the iron ore division, which is really powering along its business at the moment. It also has mining services, where net profit was up by more than 50% in these results. So we've been adding to positions in mineral resources, given the momentum that we are seeing coming through from China at the moment. One new position that we've added to is Megaport. Now, Megaport's also in the area of data and cloud services, and it's what's called software-defined networks. What we're finding is that companies, as they need data, they're actually using more than one data center. So not only do the companies need to talk to data centers, but often they're transferring data from one data center to another data center as well. So Megaport allows all of that through its software-defined networks. And I guess the good news there for companies is that they don't have to buy a whole lots of hardware, and they have the ability to use multiple cloud providers, as well as being able to increase capacity rapidly when they need it. So look, Megaport, it's in 128 cities already, 366 data centers. Revenue was up by 65% in the last financial year. We think that revenue is going to be up another 50% this financial year. So we like this one, and we think that this is a growth story with a few years at least in front of it in terms of growth.
Yeah. I know last week, I think Michael Wainsey liked the stock, and
oh, excellent.
but also it had a bit of a challenge last week, so it seemed to me that there may well be a buying opportunity at the moment too.
We've been picking it up because we have seen a bit of weakness coming in terms of its share price, but we still believe in the growth story of Megaport. I mean, the other one that we've picked up that's fairly new is Net Wealth. It's been performing very well because of the disruption that we've been seeing in the wealth sector, with a lot of advisors moving to being independent. We think that this is going to continue on, and it is going to continue to be a tailwind for the stock, but also with the end of grandfathered commissions. This is things like trailing commissions on investment products that get paid into perpetua forever until the person exits that particular product, ending at the end of the year. We think that Net Wealth's in a good position to continue growing its business. One of the things that I really like about this business is when I do roadshows and talk to different financial advisors, one of the questions I ask is, what platform do you use and what's your favorite platform? And the most common answer that I've received is Net Wealth. And I think that really reflects the investment that they make in technology. They're going to pick up another 30 staff in the technology area to try and grow its platform. And they're looking at another mobile offering at the moment. So look, not only is its user base very happy and sticky, but once you have that sticky user base, you can introduce new products as well.
Now, Julia, there's been a bit of anti-tech developments in the US, and they've come here as well. How do you, as a professional fund manager, look at this current distaste for tech stocks after them being so popular for so long?
Yeah, no doubt that some of the tech companies, we are seeing them pushing pretty expensive valuations. But in terms of the whole sector, this is a sector that's showing strong amounts of growth in a world that has low or negative growth at the moment. So I still like this space. I think you do have to be selective in terms of the types of investments and valuations, and be ready to trim when the price movement moves against you, because there is, I guess, a bit of speculation happening in this space at the moment, which can be good news for the share price when it's going up, but bad news when everyone tries to find the exit points at the same time. So just managing risk is an important element of being in this sector.
Okay, one last one. We saw the listing of a new buy now, pay later business in lay-by today. And you've always been a big fan of Afterpay and to a lesser extent Zip. Is this going to, the development of other companies coming in, is it going to really crowd the space and make it hard for the incumbents to do well? Or is the buy now, pay later space growing from those young people who started doing it to older people who are used to doing things like lay-bys?
Yeah, Pete, that's a really good question because no doubt Afterpay has had a phenomenal share price performance and we've been really happy with the share price performance. Our fund exited Afterpay on the 1st of September though, and that's really because of the news of PayPal entering the market. It's a gigantic payments operator and of course US is where Afterpay wants to grow, and that's where PayPal will be offering the pay in full installments option in the last quarter of this calendar year. So we've actually exited Afterpay, and I think if you look back on sectors that have come under pressure because of increasing competition, that generally we see all players being impacted negatively. I mean, think about the telecom sector where Telstra was the incumbent and we saw the smaller players coming in, taking away market share. You saw margins being crimped, and look, Telstra as a result seeing its earnings coming under pressure and its share price coming under pressure as well. So I think the risk of rising competition is largest towards the biggest in this space. So I'd be watching Afterpay with a close eye, and sometimes when you are in these frothy stocks, it is about moving quickly and just managing the risks.
And do you hold Zip, and have you sold Zip?
We haven't held Zip, and that's because we usually like to hold the best in the space, which we viewed as Afterpay. But Zipco will be joining the ASX 200 benchmark index on Friday. So interesting to see whether we do see a bit of support coming through because it will be joining the benchmark index. And of course, some fund managers and exchange traded funds simply replicate the index.
Exactly right. Julia Lee, thanks for joining us. Talk to you next week.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Joining me now is Jun Bei Liu from Tribeca Investment Partners. Thanks for coming on the program, Jun Bei.
It's always great to be here. Thank you for having me.
Okay, now I really haven't got any set questions, but I do have a couple of stocks I want to run by you because at the Hearts and Minds conference, you were a big fan of A2 Milk, and it copped a little bit this week. Is this a buying opportunity?
Well, for me, it is. I think this company has this amazing growth story over the next 3 to 5 years. Right now, it's copped a little bit of a setback, mainly because the stock has done so well in the last 6 months relative to some of the other companies, and the earnings delivered to expectations, double-digit growth, and hinted at another year of strong growth. So I think people are just using this opportunity to take some profit, but you know what? It provides a good buying opportunity.
Okay, great. That's the first one. And then about 2 or 3 weeks later, at another conference, you said you liked Tyro, and since it's listed, Tyro's done very well. Do you still have a positive view on Tyro?
In fact, I think Tyro is still my top 5 recommended stock. Absolutely, I love Tyro. What's really great about Tyro at the moment, not only it is a growth stock, it gives the investors exposure to growth companies. It also offers the exposure to reopening thematic, which currently many investors are searching for. Its earning was growing at double-digit, really strong growth until COVID took place. A lot of people aren't allowed to go to the restaurants and shops, and so hence since then Tyro's share price took a bit of hit, but since has recovered. However, we still believe there's a lot more to go as that reopening theme take place, and as we truly move beyond the coronavirus affected the world.
Yeah, and let's face it, Victoria is about 22% of the Australian economy. When the Victorians eventually get back to being normal, at least coronavirus normal, Tyro's machines will be ringing because people will be out spending.
Absolutely, and that's the first thing we saw actually in many other states aside from Victoria, is that the minute the lockdown gets lifted, those numbers just started flying. And in fact, if you look at the overall numbers from those registers that Tyro has, it's already moved into the positive territory, which is quite significant given, like you said, Victoria is still in lockdown.
Yeah, okay. So you mentioned the magical word of 5. Let's hear about the other 3.
I got plenty. In fact, I got like 20. But anyway, so let's go to the top ones. So Ramsay Healthcare is another one we like. It's very defensive. Its earning was impacted, of course, by the lockdown. So the deferral of some of the elective surgery. But however, aside from Victoria, every other state we've seen that huge comeback and a huge amount of pent-up demand. And then we are hearing the backlog of getting through some of those volume elective surgery is something like 12 to 18 months. We think that company will display a V-shaped recovery quite quickly. Now, we like Sydney Airport. Look, should we go through?
Yeah, go for it, Jun Bei.
Sydney Airport. Look, travel is tough at the moment. Look, there's nothing going through airport at the moment, nothing going through, no one's flying anywhere, but it's a premium asset. It is a destination that you will always have people, coming to Australia and visit using Sydney Airport as a destination. So, premium asset, very rare, quality asset trading at such a big discount to its intrinsic value. And this, coronavirus affected world has provided investor with this opportunity. Take a 12-month view. When things do resume, this company share price could well double. Okay. Now, we also like there's another company which is actually very interesting, a little bit time critical for investors too. That's Scentre Group. Look, the company, clearly, the shopping centres were shut for a period of time, so earnings were very tough. And Victoria is still in lockdown, so earning has been tough for the time being. But it is trading at 50% discount to its premium asset value, and that is significant. There may well be some structural issue of people shopping more online and the like, but still, it offers that catch up in terms of the valuation, and the company is rumored to be needing to raise money quickly because there's no earning. And as a retail investor, you should really get on the register and to be able to participate at a good discount to buy this company.
Jun Bei Liu, as always, delivered fantastically. Is there one last one you want to give us before you go?
Yeah, so one last stock tip.
Yes.
Absolutely. Look, we are a believer of, in the material space, we quite like FMG. Now, I remember talking about this stock 12 months ago, and back then we talked about how much we love it. Look, it's, it still offers really good cash flow, strong yield, in a world where everyone's cutting dividend. This one delivered a 5-6% yield just in one go. And we still see that cash flow to be very strong given where iron ore price is. We think that's still a pretty good buy. Okay,
one last issue then. How worried are you that the Chinese might keep playing hardball and maybe even take their arguments to the iron ore sector?
Look, I think that's a big risk. At this point, we don't think it's, it's a base case scenario, simply because the whole reason for iron ore prices to be where it is now is because there's supply disruption out of Brazil and South America. Chinese can't get enough iron ore. They need to use it and they can't find enough of them. So there is a demand, and it is well supplied by the likes of Fortescue. Now, if the political tension escalates, it will create a fair bit of issue for most of the mining companies, simply because China is our largest trading partner.
Jun Bei Liu from Tribeca Investment Partners, thanks for joining us.
Thank you very much.
Well, history shows that September and October are in fact the scariest months of the year for the stock market. And though I'm not expecting a big sell-off that you would expect after a period of boom and high interest rates, certainly this market has rocketed ahead, particularly in the USA, and there could be a bit of a pullback, particularly ahead of the November election, the US election. where Donald Trump is clearly trying to hang on to his presidency. So if there is a bit of a sell-off, Paul Rickard's had a look at the stocks that might be worth buying on a dip. Paul, thanks for coming on the show.
Yeah, thanks, Peter. Look, first of all, a couple of areas I don't want to buy, and this is all it's all predicated on the idea there will be a bit of a dip. We've seen a couple of days of it. We're probably going to see some sector rotation if it continues. But look, I'm not interested in travel stocks, Peter. I think that they're already pretty well fully pricing in the recovery and so forth. I'm not interested in retail stocks, Peter, because I think they're going to. The spending.
Had a big run, haven't
There's
they?
been so much spending. It's going to be a bit harder come October. Yeah. And then I'm not so interested in the IT stocks, although I do like one. But I think that's where we might see some rotation out of.
Okay, so let's run through. You've come up with 5 stocks worth thinking about. And the first one will shock a few people, AMP.
Look, I've only put AMP in there, and I wouldn't have thought about this a week ago.
No.
So this has all come since the new chair at AMP, Deborah Hazelton, has decided to finally break up the company. I've always
Which you've been saying for a long time.
Always thought that was going to be the likely outcome, and it's just a sum of the pieces valuation, Peter. When I look at the money that AMP would get by selling AMP Bank and AMP Capital, plus there's a special dividend of 10 cents, plus there's some surplus capital. That comes to something.
And even the wealth management business could be sold
and
for
even
something.
the wealth management business or parts of the platforms could be sold. Look, it comes to something a lot more than it's currently worth. It's not somewhere between, I think, about $1.75 and $2. But
and what's it now?
Look, it's around about $1.59, $1.60.
Okay.
But look, so it's not a lot of. I don't think there's a lot of downside in it.
Okay.
So it's one of those sort of small speculative buys for what I think is the inevitable, the breakup of AMP.
Yeah. Let's go to the second one. That's A2 Milk.
Look, a company that I really like, A2 Milk. It's been hit hard post its results. I guess for a couple of reasons. One, Peter, is that there's obviously the China concern. I think that's a bit misplaced. Because it is a New Zealand company.
Yeah, it's not an Aussie company.
New Zealanders say they're different, but also just the exposure to the Diageo and others in terms of how a lot of their milk products are purchased or their nutritional products are purchased. But they're increasingly got a presence in mother and baby stores right throughout China, about almost 20,000 stores now. Look, it's growing at about 30%. The market likes the growth, but it had to run pretty hard into the results. I think there's value there. I think that's a company for the long term. Back the track record, I say, and not the market.
Okay, a company that we've always thought was good for the long term and has come off its highs is CSL.
Yeah, another one to back for track record. Again, look, it reported well. The market was a little disappointed with its outlook. But look, it's spending a lot more on R&D, which it expenses this year. Also some concerns around the blood plasma collection in the US. But put both those things to one side. CSL has delivered year in, year out. Got some upsides with the COVID-19, 1 vaccine trial, 4 treatment trials, so potential upside. They're saying that this Northern Hemisphere, the influenza vaccination business is going to be really strong in the Northern Hemisphere. So, look, I think there's upsides with CSL. It doesn't seem to want to go to much. Currency might be going against it, but that's a company to buy in a dip.
Okay, Xero.
Look, probably my favourite IT stock. I think yours too, Peter. The question about Xero is not that it's a great company, has it been too expensive, right?
Yeah,
and,
exactly right.
Analysts have got a valuation of about $75 on it. I guess you could say it in the low 90s, it looks pretty steep. And it's got to increasingly go out of Australia for growth because, it's pretty well saturated, the Australasian market. So increasingly growth is coming out of the UK and the USA. Surprisingly, from the data that Xero says is that you might think, everyone's on the cloud these days, a cloud accounting software would be the go. In other parts of the world, they're still using packages,
and
package software, and
disk. Yeah.
So I think lots of opportunity for Xero. The question's been about the price. I think you got to buy it when the market doesn't want it. If we do get some rotation out of IT stocks, this is a company look to buy. Maybe the low 80s is the area for Xero.
Okay, and finally, Lend-Lease.
Yeah, another company I've been on my radar, Peter. I think Lend-Lease has got a really interesting business in terms of backing the global urbanisation theme. Now, you can say that post-COVID-19, is some of the trends toward urbanisation going to change? Because if anything, it might be a little bit of concentration or movement away from the very concentrated CBDs more into the suburbs. But Lend-Lease has identified about 14 or 15 what they describe as sort of global benchmark type cities that it wants to back, places like Boston and London and obviously Sydney and Melbourne. It's developing more in sort of integrated development, which are communities, a bit of residential, a bit of retail, aged care, all in the one. I think they're doing interesting things, Peter. Now, it's mainly, as much as a development and construction company, it's also a financial company. It's got a big funds management business, got lots of partners.
Nursing homes as well, haven't they?
Yeah, look, certainly aged care and obviously now in development of units to rent seems to be part of the growth area. Look, it's one to watch for a markdown. I think it's got an interesting future. A little bit more risk, of course, because how COVID-19 plays out and that sort of, that's decentralisation theme, I think, or the urbanisation theme is going to be important, but one to look for in the portfolios.
And if you want to see more about what Paul's talking about, you can go and take a free trial for the Switzer Report. Just go to switzerreport.com.au. I've written a piece today in case you're looking for dividend-paying stocks. Some of the dividend-paying stocks out there which have got pretty good history also have some upside in terms of their capital gain potential. So have a look at switzerreport.com.au. Thanks for joining us on the show. See you next week.